Hello everyone, Trading Tutor channel. If you'd like to create a free Demat account with Alice Blue, click the link in the description and fill out your details. You'll also get free intraday recommendation calls and you can learn robo trading software. Now, let's look at long straddle, which is an options trading strategy. What is long straddle? A long straddle is an option strategy where the trader purchases both a long call and a long put on the same underlying asset with the same expiration date and strike price. The strike price is at the money or as close to it as possible. The goal is to profit from a significant move in the underlying asset in either direction. Now, long straddle positions have an unlimited profit and limited risk. The profit when the price of the underlying asset is increasing is given by profit is equal to price of the underlying asset minus the strike price of the call option minus the net premium paid. The profit when the price of the underlying asset is decreasing is given by profit is equal to strike price of the put option minus the price of the underlying asset minus the net premium paid. So the maximum loss is the total net paid plus any trade commissions. This loss occurs when the price of the underlying assets equals the strike price of the options at expiration. So here are some of the terminologies which will come up when you're using the long straddle trading strategy. First is maximum gain, then there's the maximum loss, and then there's the break-even points. Now, what is maximum gains or maximum profit? By having long positions in both call and put options, straddles can achieve large profits no matter which way the underlying stock price heads, provided that the move is strong enough. The formula for calculating profit is given by maximum profit is equal to unlimited, which is obviously, and then there's the profit achieved when the price of the underlying is greater than the strike price of the long call plus the net premium paid, or price of the underlying is lesser than the strike price of long put minus the net premium paid. So the profit is price of underlying minus the strike price of the long call minus the net premium paid, or the strike price of long put minus the price of the underlying minus the net premium paid. I hope that was clear. The maximum loss for long straddles occurs when the underlying stock price on expiration date is trading at the strike price of the options bought. At this price, both options expire worthless and the options trader loses the entire initial debit taken to enter the trade. The formula for calculating maximum loss is given below. The max loss is equal to net premium paid plus the commissions paid. And the maximum loss occurs when the price of the underlying is equal to strike price of the long call or the put option. Then there's the breaking point. There are two break-even points for the long straddle position. The break-even points can be calculated using the following formula. The upper break-even point is equal to strike price of the long call plus the net premium paid, and the lower break-even point will be strike price of the long put option minus the net premium paid. Now let's look at the advantages of the long straddle. It's able to profit no matter if the underlying asset goes up or down. The unlimited profit if the underlying asset continues to move in one direction. And it saves time from having to analyze if a stock will go up or down ahead of a major news release. The loss is limited to the debit paid. If the volatility is low at the time of purchase and volatility rises, both options could profit even without an appreciable change in the stock price. Now, here are the disadvantages of long straddle. There will be more commissions involved than simply buying call or put options. You can lose more money if the underlying asset stays stagnant than if you simply bought a call or a put option. If the underlying asset rises above the strike price or falls below the strike price but remains below the upper break even or above the lower break even, you will still incur a loss on the position. If volatility falls for both or either option, the position could lose with or without a price swing in the underlying asset. Thank you for watching this video. For more videos on stock market and trading, please subscribe to this channel. If you'd like to create a free Demat account with Alice Blue, click the link in the description and fill out your details. And once you upload the relevant documents, your account will be activated within 24 hours. And you can get intraday recommendation calls and you can learn robo trading software for free.